Get straight into it. Julia, your thoughts on the session today?
James, a really quiet session once again. In fact, in the month of July, the market has really struggled with that $4 billion worth of stock being traded per day. I think there's only been 2 trading sessions where we've overcome that $4 billion mark. So once again, below $4 billion, the market up just slightly, up by 0.2%. We've really tested that 5,000 point resistance mark today, and this has been a key mark for the Aussie share market in 2013. We did go past that 5,000 point mark very briefly, then back under it, so it does look like a fail of this 5,000 point resistance mark. We just have a look at the Australian share market and have a look at it in 2013. This is what it looks like. I've just drawn a line at that 5,000 point mark, and you can see that essentially the market has just been oscillating around that mark. We've been up as high as 5,200 and as low as just under that 4,700 point mark, but it does look like that 5,000 point mark, really the midpoint of the Australian share market. So that's going to be the test for the Aussie market in the near term. If we have a look at the lead-in from the US, it was a good one. We were watching Ben Bernanke's speech, but not a huge reaction to it in terms of markets around the region. But we were watching some domestic numbers coming out. The IMF yesterday had been warning about the downside risks to China. And of course, today in China, we did see new home sale prices. And it does look like out of the 70 surveys, 70 cities that were surveyed, only one city actually saw a decline in the month of June. So it does look like the housing market still quite robust over there, and of course the authorities are quite concerned about the heat in that housing market. The NAB business survey domestically, we did see confidence at a reading of -1, so deteriorating for that second quarter. And in terms of sectors, the material sector has been one area that has been doing well all week, but today we did see a bit of a reversal. They're down by 0.2%. We saw the gold miners being hit hard by that lower gold price, but on the flip side, with that higher oil prices helping that energy space and the defensives once again being sold off, it does look like we are still seeing that shift from more income type stocks into more growth type stocks. So we did see the healthcare space, the utility space and the consumer staple space all finishing in the red today.
We've seen, Julia, I wanted to get your thoughts. Woodside today coming out with their quarterly production reports. The shares actually finished pretty flat, but we saw a drop in revenue for the quarter.
I don't think there were any surprises here, given that we did see an update from Woodside Petroleum back in July. So earlier on this month, we did see that production downgrade coming through, where Woodside Petroleum was forecasting 85 to 89 million barrels of oil equivalent for the year. The key thing is that Vincent is offline, and that's not going to come back online until October. And this is important because if we have a look at 2012 oil production numbers, Vincent made up around about 36% of production. So that's impacting. We've also seen, I guess, some planned maintenance in the Northwest Shelf, which has also impacted, and some work at Pluto that's impacted as well. So the second quarter numbers, we did see a softer set of numbers coming through, 20 million barrels of oil equivalent, and of course that meant lower revenue as well. So revenue coming in at $1.35 billion. That's compared to the first quarter where we did see it coming in at $1.45 billion. But as you can see from the share price reaction, it was probably all expected. No real surprises in this result coming through, given that earlier on this month we saw that production downgrade come through.
Do you see better times ahead, Julia, for the stock now that's sort of moving beyond some of these glitches they've had in production?
I think with Woodside Petroleum, we've got Pluto up and running, and that's really adding to its production profile. And also, if we see Vincent coming back online in October, that could be important. In terms of the oil price, you know, they're still getting just over 103 US a barrel, so looking quite healthy from a historical standpoint. So I think things are moving in Woodside Petroleum's favour at the moment. One of the things that we are watching are future projects, especially the ones in Australia. Some of these LNG projects have been hit with higher costs, and that's really what we're watching. The capital expenditure on some of these new growth projects are coming through in its growth pipeline. But its current operations, come the end of the third quarter, things should be back up and running quite smoothly. And I guess in terms of Woodside Petroleum, they do tend to be a little bit on the conservative side when they do come out with these forecasts.
What about future assets like Leviathan off the coast of Israel? I think it was earlier this week, might have been last week, some speculation that their production targets may be a little overly optimistic.
I guess if we have a look at those Israeli assets, these are new assets. So just really watching Woodside Petroleum to see what it does in terms of a growth plan for these assets. And really, I think it's a balancing act at the moment where they're looking at the assets and the potential growth of these assets and really just balancing it with market expectations, because we know that capital expenditure costs have been blowing out. And we know that Woodside Petroleum has also moved to a more conservative stance when it comes to shareholder policy. Its dividend payout ratio moving from 50% to 80% this year, and that really indicates that Woodside Petroleum is becoming more of a larger conservative income type of stock, where instead of keeping the profits to reinvest it back into the business, it's choosing to pay out 80% of its profits back to shareholders as a dividend. So I think that's a key signal that Woodside Petroleum has given this year, that instead of focusing in on growth, it's really going to be looking at focusing in on maintaining that cash flow and returning that cash flow to shareholders.